right, we're back with another episode of First Funders in this brave new AI world. Today, I've got a dear friend, Shahram Seyedin-Noor, who is the founding GP of a fund called Civilization Ventures. Now, Shahram and I go way back. We've shared the same co-working space for maybe more than a decade, maybe even close to 15 years. I can't remember exactly how long it's been, but from over that time, we've both evolved from both being founders and operators to investors, though you started your journey much earlier than I did. And I'm just so excited to have this conversation on the podcast because he's really carved out success in a league of his own. I've been watching him since he made the jump to being a GP, running his solo GP fund since 2017. And within 10 years, you've had 3 IPOs. Is that right?
Correct.
It's amazing, right? Rocket Pharma, Omada Health, Billion to One. This is like all the while he's someone who shows up with his own thoughts on how the world is evolving, real perspective as a founder and operator, and more importantly, all wrapped up in a warm and humble personality that you don't always experience in venture. So it's so fun to have you on the pod because I can so relate to so much of how you show up in the world and how you operate. So welcome, Shahram. I'd love to start with just a quick intro. Tell us a bit about who you are and, what led you to becoming a VC.
Thank you very much, Sean Rose. First of all, so great to be on this show with you, your podcast, and all the feelings are mutual following your journey through the last decade plus. And I remember plane rides when we were catching up on philosophy, startups, life, and seeing the arc for you. And now taking all your experience as a founder and passing it on to the new founders that you're funding. I think that's invaluable for them. So I'm humbled to be on your podcast, ecstatic. And, we're also neighbors. We live a few miles from each other. So it's really wonderful to come full circle. And thank you for inviting me to your show. As you stated, I started my fund in 2017. I like to say that I started the fund through process of elimination. I kind of thought about after spending a decade as an operator. So just to kind of quickly maybe bring your audience up to speed on my own trajectory, I started with an undergraduate econ degree where I was also pre-med from Pomona College, got my law degree from Harvard, JD, and then I came to Silicon Valley 27 years ago, where I began my career at Wilson Sonsini working with tech startups during the 1999 crazy dot-com boom that I witnessed firsthand doing IPOs, M&As, et cetera. 7 years of my career was spent doing law and banking. So I worked at Wilson, worked at Goldman Sachs. And when I finally paid off my educational loans and was able to save up some money, I took the risk of joining my first startup out of Stanford, a company called Nextspire. And that company we sold to Illumina. Back then in 2006, 2009, it was very difficult to get funding for a software company in the multi-omics or genomics space. And so, I joined a 2-3 person team. I spearheaded the fundraise, we rewrote our deck, and we were successful raising 20 million at a time when that was an anomaly in our categories. There's early days of software in biotech. The next company that I started after that was called Inspirna. The original name was Argenix, which changed the name to Inspirna. Several MD PhDs from Harvard that I was classmates with had novel biology around cancer, therapeutics, and targets. Long story short, 150 million raised for that company. For the first 7 years, I was involved as CEO and executive chairman, and then I started my fund. So going to the story of 2017 when I started my fund, it was through process of elimination. I thought to myself, I've done these startups. They tend to be very binary, obviously. And in the case of therapeutics, even more so, because not only does a startup face the binary outcome, quote unquote, of financial success or not, but in therapeutics, you have a binary outcome for your asset. It's not as if you have product market fit and then you scale. You pretty much just go until the phase 2 and then you find out if your drug works or not. So it's very, very binary. So I thought I had just turned kind of 40. I thought I can't do that again. You can't just keep rolling the dice. Even though I loved learning about therapeutics and having run a therapeutics company, I have a lot of learnings that I hope to pass on to our founders. But I thought I'm not going to do that again for my sole job. And I also tried to look at what are the things that I particularly felt differentiated in, was passionate about, and where I thought long-term trends were very positive and could lead to outsized financial outcomes. So kind of a Venn diagram of my passion, my experience and differentiation, where the market economy is. And to my own surprise, it led me to think about becoming a venture capitalist because, again, it's not as if I had, my parents didn't go to college. I'm an immigrant from Iran. I came here when I was 8. We escaped after the revolution because of the theocratic government and dictatorship that took hold after the revolution. So we came to America in 1982. So it's not as if I grew up in a family of venture capitalists. It's funny. I see people's resumes these days, Sean Rose, and it's like the guy, the person is a undergraduate student at Berkeley, and they've done like 3 internships at Goldman Sachs and at, Genentech in high school. And it's like, I was working in the stockroom at Nordstrom, just trying to make a buck. I was working at Manpower doing menial jobs in high school, proctoring exams for postal exams, just because that was the only job available in Portland, Oregon, where I was raised. Even though I was a, straight A student, I was like, today that person will be doing, an internship at KKR. But where I grew up, it just wasn't, those opportunities weren't available. So I grew up, what I consider a normal childhood. There were no internships. The peak of my internship experience in high school was doing a C++ class at Mentor Graphics, which was in Oregon. Maybe it was C++. Anyway, one of these computer languages we were learning in high school, just kind of become a little bit smarter about it. But those opportunities weren't available. And really, I learned about venture capital in law school. And we had a class called the High-Tech Entrepreneur, which was the weirdest class in law school because there's no law about it. It was just, the assignment was go start a company. And so I did. In 1998, I started an online art store with 2 of my classmates, which we didn't continue because we had to get real jobs after graduating. But that flavor in my mouth was like, I want to be an entrepreneur. Now, fast forward to 2017, I didn't know what venture capital really was until I started my career. But by the time I was kind of in my early 40s, I realized that's what I should be doing, because that was where there was a really strong convergence of my operating experience as I'll just call myself a non-technical founder, because I was always the business person. And I consider the technical people, even though I have obviously technical expertise, I consider the really technical people to be the PhDs and the people, the developers writing the software, creating those products. So I understood what my lane was. My lane was to understand enough about the technology that I could run a company, but I'm not the one in the lab and I'm not the one writing the code. But you have to be able to understand what that is. Where I was actually deeply technical was in governance, operations, recruiting, market, sales, business development, M&A, finances, all the other things that are not you doing a pipette in the wet lab and or typing code, which now AI does that anyway. So I thought, given my passion for the industry, the fact that I had a vision and a perspective for where it was going, and the specific set of skills that I had, I think it kind of makes sense for me to try to be a venture capitalist. The other thread in that was that I had begun angel investing during my tenure as a founder with my own, I'll just say, modest savings account. I had paid off my Harvard and Pomona College loans at the time, 9% interest rates. Yeah, this is a different era. 9% interest rate. Biden was not there to forgive those loans, so I paid them off about $100K, and then I started investing what savings I had, call it a few hundred, and I started learning a lot. And I luckily turned out that I was very successful as an angel investing in life sciences, software, and other companies. And I thought, really enjoyed being an investor as an angel because I could interact with founders, kind of consult, advise them while I was running my own companies. Why don't I institutionalize that? And my new company can be a VC doing that. Again, I was very kind of unstructured in how I was thinking about it because I knew so little about venture capital, even though I would say, a sophisticated person, having worked at tech law firms and big investment bank like Goldman Sachs. When you enter the world of venture capital and you start your own fund, you learn a million things you had no idea about. And so I teamed up with a great lawyer that was introduced to me and started learning about venture capital. And the rest is history. I started really with the mindset of a founder as a tech founder, or biotech founder. And what I mean by that, Shahram, is that when I started my fund, the question I asked myself was, I don't want to be out on the road for 2 years fundraising, which is what I heard most VCs did, especially first-time founders who are VCs, first-time fund founders. They would often spend 12 months, 18 months just meeting with these creatures called limited partners that would then become your investors, and then they would start investing. I'm just not that patient. I'm not going to go on the road for 2 years and beg for money and then invest. I thought, I need to first establish an MVP for my fund. And that means that the smallest amount of capital I could raise, augmented, of course, with my own, and invest that, see if I enjoy it, see if I could add value to these founders, see if I could be successful, see if the thesis is valid, and then I'll consider a second fund. And I'm not doing it. There'll be no fees from this fund that will be meaningful for me. It's just really trying to see if the product market fit is there and if the founder product fit is there. me as a founder of the fund. So in 2017, I closed literally within a few weeks, I closed $1 million pilot fund, and I immediately started investing it. And that's when things got really interesting because within 12 months, I had invested that million, but I also learned about something called special purpose vehicles. So I augmented my investments with millions more. And it was a really interesting time, 2017, 2018 in the life sciences, health tech space, because things were getting kind of, there's a lot of momentum. And I was able to have a lot of exits early. So I invested in about 20 companies on that $1 million fund, and I started doing special purpose vehicles on top. And it turned out that our investments had, double-digit multiple returns in companies like Rocket Pharma, which went public through a reverse merger and is now Nasdaq listed, as you imply. And that actually is the first company that I've ever invested in that has an approved FDA drug. They just got an FDA drug approved for LAD1, which is an ultra rare disease. So pretty amazing milestone for our fund and for myself. And really the real milestone that matters, because now you have a drug that can help patients. That's a genetic medicines company. We had Singular Bio that was sold to NVT, where we made a huge return. And then we had Omada was in that cohort, which went public. Billion to One was in that cohort, which went public last year. So that 2017-18 vintage ended up being quite interesting. And on the back of that, I raised Fund 2 in 2020, right as the pandemic hit. And that's when I became, I would say, a real fund manager in the sense that I had real assets under management. Now we're managing over 200 million of capital. With back then, I started with $1 million fund. So I feel like you really can't get smaller than that. I know AngelList has a program, and of course, you and I both know Naval and the wonderful people who started AngelList. They had a program where they would sponsor people for $1 million, and I didn't really apply to that program. The other thing I wanted to say, Shahram, was that the reason I started my fund is I don't like reporting to other people, and I'm not even convinced that had I applied to other venture capital firms to get hired, I'm not even sure if they would even interview, because oftentimes there's a huge bias of, well, you're not a PhD, you're not an MD. What do you know about healthcare or biotech? People really discount operational experience, and they also discount the idea of being an autodidact. I think most people take it for granted that Elon Musk is brilliant, but he didn't get it. He learned it, and he's just a savant. And I'm not in any way putting myself in the category of a savant, but I am someone who is very interested in science and reads about it a lot, to the point that when I enter a meeting, I don't consider myself to be deficient in kind of foundational knowledge, and I and my team will ask questions that pretty much go to the root of the problems the founders are tackling within a few minutes of the call. We don't like wasting time because we want to be able to give real feedback to the founders. And I think what I've also found is that the experience that I have and the reading that I've done and the research that I've done has just compounded. 8 years after starting my fund, really 18 years after being a founder in the biotech space, I would enter meetings with VCs who were PhDs from Harvard and Stanford, and I would know more about the science than they did because I had been spending time reading about it. And the way it works in the PhD program is if you're very narrow and you're working only on, microRNAs, you're only working on, bioinformatics, you don't know about other things because the world of the PhD is quite solitary and can be very narrow. And so that was, for me, something also, Shahram Rose, that gave me confidence to start my own fund because frankly, 17 years ago, I thought to myself, geez, I really don't know anything.
Yeah.
I mean, these people went to scientific PhD programs. My background is in business and law and banking. Like, what do I know? It was only after year of being in the salt mines, of building companies, being at the bleeding edge of where the technology was going in biology, that I felt that I really understood the landscape of how venture capital invested in bio.
Yeah.
I saw the holes in venture capital and how they were approaching bio, and I saw my opportunity to enter. So I wanted to talk about that next, but I'll stop there.
No, that I'd love to hear more about that. I think there's so much that you just shared that when we caught up, when I came back to the Bay, 2 years ago, and we sat down for coffee, and you shared the part of this journey. And by the way, thank you for sharing the detail of it because I think it's so beautiful for people to know a bit about how you got here and how you see the world. But like someone who has operated, understands the science from a broad view over time, I agree with you, is something that is very unique, right? And not coming in after just having done a PhD and in their field, but also then what you talked about, having been doing institutionalizing your angel investing, you know, even just your journey as an immigrant, all of that plays a beautiful role in who you are and how you invest. And so would love to pick up the thread on what you were going to share, and also loop in a bit about, you know, what you invest in today and why. Like, what's the
Mhm.
why on some of the bets that you're making?
Well, that's exactly where I was going. So I'm glad you brought that up. I really believe that in venture, you have to have some unfair, I mean, in startups in general, but
Yeah,
certainly this applies to venture as well. You have to have some unfair advantage because you don't want mediocre returns.
right.
And in general, most people are by definition average. Right? That's what the average, that's what the word average means.
Yeah.
It's based on what the average person is. And what I noticed was that in the field of biotech, having worked in tech and bio, there was this conservatism,
Mm.
which can be good, but also can be a little bit disruptive.
Mhm.
So where I think conservatism in biotech is very good is rare. You don't lie about the science or fudge the data because you're really lying to yourself. I mean, there's no,
Sure.
you see in tech or in business, people will inflate sales figures or do all kinds of things that make the company look superficially better than it really is.
Right.
In bio, if you do that, first of all, it's not legal. Second of all, you're actually just setting yourself back because you need to be able to objectively look at your results and your approach and understand which way uh, you're trending to be able to correct course. The founders that I love working with the most are the ones that are ruthlessly honest with themselves and with me
Mhm.
about what the data shows. And I especially love it when founders, for example, in a therapeutics company say, look, this experiment didn't work out.
Yeah.
And I don't know why it didn't work out, but I just wanted you to know because you're my investor. I have founders like that. I mean, a great example is Shaket, one of our PhDs from Berkeley, who we backed for rewrite and replace therapeutics. We sold rewrite to Intellia for 200 million. We were the only investors, and he was one of 3, 4 people in the company, and the only one of the 2 co-founders. His co-founder was David Schaefer from Berkeley. He was a wonderful and accomplished professor there.
Yeah.
And then we backed them for replace, and we sold that to Tall Bio. But Shaket had tremendous success experimentally. But there were points during the journey where things didn't always go according to our plan. And what I loved is that he would immediately call me. He actually would affirmatively call me and update me on that, really treating me as his team member.
Yeah.
And that's kind of why I do this. I want to be a thought partner and a virtual co-founder for all my founders.
Love
And in fact, I think that hopefully I'm able to add unique value because I am the business person and they're the scientists. So it's like a perfect marriage of attributes. And this goes to the thesis. So what do we invest in
Yeah.
and why? One thing I noticed when I spent a decade pitching to VCs as a biotech founder was how they just didn't like young founders. I mean, relative to tech, they
Yeah.
were heavily biased against young founders.
Mm.
If you're a tech founder who just dropped out of Stanford, or better yet, who didn't even go to college, a Teal fellow, you'll be worshipped in Silicon Valley as being
Totally.
contrarian and disruptive. In biotech, you pretty much won't get the meeting if you're a dropout. And if you're a PhD, the meeting will be okay. The traditional biotech funds, God bless them, I respect them, but the traditional biotech funds, the discussions behind closed doors immediately are how to replace this guy.
Wow.
He's never run a company, or she's never run a company. That is something that to me, as someone who early in their founding career had not run companies before,
Yeah.
it did not make sense.
Mm.
Because as long as you have the horsepower, you have the intellect, the drive, the integrity and the work ethic and the team to get there, you'll get there. You can hire gray hairs that have done it before and can provide you the regulatory expertise, the medicinal chemistry expertise, all these things that are the blocking and tackling involved in drug development
Right.
or in diagnostics or what have you, laboratory operations, et cetera. This is how you build a team and hire.
Mm.
You don't need the founder and the CEO to be an expert in all these things. And in fact, if they are, that's definitely the wrong, what we call phenotype or profile for the founder. So I thought this didn't make sense. We need to disrupt this biotech industry
Mm.
and back first-time founders. And I'm going to mentor them to the best of my abilities to fill the gaps so that we're actually not deficient.
Yeah.
Because I've run companies for a decade.
Mm.
So that was the first disruptive
Very
part of
cool.
my thesis, which in 2017, there was not a single fund run by a biotech expert operator, as opposed to a tech bro, a biotech expert operator that had that thesis.
Yeah.
Not
Yeah.
one. Today, there are more than one, which is great. But back then, I think I was, and by the way, not a single fund. Back then, we could argue I wasn't even a fund, right? It was like
Yeah.
$1 million fund. One could argue that's not a real fund, but my thesis was very unique,
Correct.
and I leaned into it very, very hard, and it resonated deeply with founders because they were experiencing this bias from the big funds.
Yeah.
That's A. B. When I was an angel investor and a founder, I spent most of my time outside of therapeutics. I mean, I had one company that was therapeutics for 7 years, but my angel investments were all outside of it. They were tools, software, informatics, diagnostics. And I love that category. One, just intellectually, I love the idea of measurements and accuracy of testing. Two, I found it more accessible to me intellectually. And three, you really can't have precision medicine without precision diagnostics. It's two sides of the same coin. I mean, you have to be able to target a drug towards a mutation or towards a certain patient profile. And the only way to know that is to measure, or you have to know the patient even needs a drug by measuring whether, let's say, cancer is there or has recurred. These are all diagnostics.
Yeah.
You have to be able to measure, you have to be able to diagnose a fetus to see if they have some recessive condition or some aneuploidy or whatever condition is relevant to the fetus that you can then act on. Those are diagnostics. And it's a big market. Believe it or not, Shahram Rose, in the world of biotech, to this day, diagnostics is considered a dirty word. That dirty word phrase is verbatim from what I've heard. It's what I've heard from other fund managers, where I've tried to pitch some of our portfolio companies to very multi-billion-dollar biotech funds. Hey, would you please meet with my friend Shahram Rose?
Yeah.
She's running this amazing diagnostics company. Did you just say diagnostics? It's like, didn't you know that's a dirty word in our industry? We laugh about it, but they kind of mean it. And I've heard it from LPs. They're like, diagnostics? Oh my goodness, that's horrible. And I'm just like, yeah, that is why we are Contrarian.
So wait,
Because
why? Why is it a dirty word? As someone who's not deep in
That's
this
a really
field?
good question. To this day, I'm not sure if I have a satisfying answer for that. What I do know is that the whole industry in biotech has more or less been formulated around the concept of taking drugs to clinical trials.
Yeah.
And the capital intensity and the expertise involved in that, and seeing binary outcomes come out of those trials that could then be very lucrative. And what happens after a clinical trial is that you could have a 20, 30x multiple return just based on the readout. And that's kind of satisfying if you get it right. Now, most smart VCs will exit before that because 90% of drugs fail, right? So if you're a smart VC, you do, build to buy, where you sell an asset to a pharma where they take the risk on the phase 2 efficacy. But nonetheless, when you have an ecosystem developed to fund these types of assets, then naturally their success and failures are hinged on that approach. And going outside of it to diagnostics, it just doesn't feel natural to them. The same reason why a crypto investor doesn't invest in, aviation. It's just maybe not what they do.
Wow.
And I think ironically, life sciences and health is very heterogeneous in that respect. And all the big returns had been, Metsera selling for 10 billion or, StemCentrix selling for 5-10 billion to AbbVie. And these are the blockbuster returns that get you on the Midas list, or make you a big fund manager in biotech. And these guys lean into it hard. And that becomes kind of 95% of what they do. They have dabbled in diagnostics and not done well.
Wow.
So hence they're like, well, why am I even bothering here? Where, when markets are good, and this is the other thing, is that there's a lot of cyclicality in biotech. So in 2020 to 21, we benefited from that as well. Right? I remember in March of 2020, as the pandemic hit, the market just crashed and everyone thought it was over. And then within a few months, for whatever reason, the biotech market just exploded again. And you had, tons of IPOs. 40% of IPOs were preclinical companies. They had no human data whatsoever. So these are companies that are essentially going to fail their trials. Because those are the stats. And so you had tons of VCs making lots of money because companies were going public, irrespective of data. And then when the data read out, which 90% of the time it was negative, they would crash. And now those companies are either shut down or most of them are trading below their cash position. They have negative enterprise value. But when the times were good, those funds did well. Now those funds are all doing terrible because they were all herds. They were lemmings. They were all doing the same thing. We didn't do that because my thesis was always different. Remember, my thesis was to back both seasoned entrepreneurs, but also first-time founders, as long as they're the complete athlete that we're looking for. And our pillars of investment, which I still haven't gotten to, are 3. So one of them is genomics and diagnostics. The other is software, digital health, and AI, just pure software plays to make healthcare more efficient, to really utilize AI in the provider space context.
Yeah.
And the third category is therapeutics.
Mm-hmm.
But when we do therapeutics, we like to go into the areas that are curative. It's really valuable to be able to extend life by 3 to 6 months. And there are drugs that get approved for that every day. And we just saw a drug get approved for that in pancreatic, where they're not approved, but they released data where they're doubling the time of survival for certain pancreatic cancer patients from 6 months to more than a year.
Right.
And so I do consider that valuable.
Right.
I think, especially since these averages don't always tell the full story. Sometimes you have some cohorts where the drug cured, therefore the average is 6 months, but some are cured. However, I personally was not interested in such incremental changes.
Sure.
My theory has been now for several decades that a deeper understanding of genetics itself, and of course, next-gen sequencing and its arrival, and the deciphering of the human genome in 2000 as a composite and now individually for all of us, as well as the genomes of tumors and all kinds of disease. These things have unlocked a revolution in what's happening in medicine. And diagnostics is a core component of that, which is why we do a lot of genomics-based diagnostics. But the other component is curative treatments that are genetic medicines, because now you understand the genetics of the problem. And so we have companies that are doing DNA editing using CRISPR-Cas9, prime editing type solutions, etc.
Yeah.
We have RNA editing, transsplicing companies that are using that modality. We have lots of cell therapy companies. We have more than a half dozen companies in this category alone. We've invested millions to really get to the heart of the problem and cure diseases at the genetic level.
Yeah.
And I think we're really one of maybe 5 funds in the world, and as far as I've been able to count, that has 3 genetic medicine exits. Most funds that are our ilk, that have been around for 7, 8 years, have 0 exits. We've had 17, of which 3 are genetic medicines, 3 are diagnostics, and the rest were digital health, et cetera. So our thesis is seasoned and first-time founders, which is novel thesis, diagnostics, software, curative treatments.
Love it. I mean, and you said it so simply, but really there's that layer of genomics, genetics, really curative approaches. I feel like you're like a root cause based investor, right? As opposed to symptom management, life extension, on the therapeutic side. And you're really just like paying attention to the latest technology that you can run.
Shahram, there's another reason I did that. Again, you and I are familiar with founder, having been founders, and it's not glamorous, but you and I know that it's not glamorous. Being a founder, and I say that to illustrate, when you're a founder, you have to establish product market fit.
Yeah.
And you have to establish your differentiation, and you have to establish your unfair advantage, not your fair advantage, your unfair advantage. What does unfair mean in this context? What is it about you, your background, your experience, your insight, your net worth, your capital, whatever it is, that gives you an edge, which others will just always be playing catch up?
Yeah.
That's the key. And so I thought I'm a fund manager, as you said, a solo GP. Now that's changing over the next 12 months, but still technically solo GP, I guess, from a legal perspective. But that's not a good thing. Fortunately, I have a team that's way smarter and stronger than myself. We have wonderful investment partner, Sonia Sazaya. She's a PhD from USC. Wonderful operating partner, Angelica Parenti, who's been at Sutter Hill Ventures and other companies. A wonderful new associate we brought on board from Stanford, Sarah Loveland. So I'm very fortunate that our team is absolutely stellar, all of them much smarter than myself. But when we started the fund, when I started the fund, I had to ask myself the question, not only what are my passions, but where can I be differentiated and have an unfair advantage?
Yeah.
And I realized I'm not afraid to take that kind of risk.
Yeah.
Not only am I more interested in curative treatments, I actually think that's the area where the OrbiMeds of the world and the big funds had not yet established leadership because the modality was so new.
Right.
You have to remember, we only have 2 cell therapies that are even approved. I guess 3 now for blood cancers. Like cell therapies, which are genetically engineered immune cells, what's called CAR T, chimeric antigen receptor therapies. These treatments are new enough that in 2017 that there was no approved drug. And though the seminal paper on CRISPR gene editing by Jennifer Doudna and Carpentier, point of pride, Jennifer went to my college, Pomona College.
Oh, cool.
That paper was in 2012. So you just think about it, like it's so new. It's not as if some, established venture capitalist had a huge edge. They were reading the same papers that I was.
Yeah.
Right. And so I thought, I'm going to go into that area because it's the area that I think matters the most,
Yeah,
which is curative treatments.
totally.
And no one else has established a moat as
So,
a fund.
I mean,
So I'm going to go there.
I think
And I
like
did.
this is the smartest thing, right? Like I think about that as, winning in that space. But what comes up for me then is what you said is if the funds that are following you don't even have their own thesis on this, how are you getting your founders funded after your first check?
They have a thesis. I don't want to give myself too much credit. I mean, everyone was well aware of genetic medicines. It's just that when most funds had an expert network that was primarily a medicinal chemistry, small and large
Mm,
molecule network, it's not as if they had the muscle memory of how to run and exit a genetic medicines company any more than I could develop the
mm,
current with them learning and coming up the curve. And and therefore, it was differentiated for us to focus almost exclusively on that.
yeah,
Just like we focus disproportionately on AI. I mean,
yeah.
I happen to be someone who has run a software company, right? NextBio, the first company that I was an executive in, I was CFO, GC, head of BD, et cetera, corp dev. But we were a software company. So I was hiring
Okay.
PhDs out of Stanford to do curation of scientific information to be put into our search engine or correlation engine,
That's right. I
which
remember that. Yeah.
became known as the correlation engine when Illumina launched it after
Yeah.
acquiring our company. But I was hiring informatics algorithm experts and computer science engineers and developers. And in fact, one of my good friends and advisors is now running software at Grail. So he
Mm,
was our CTO, a wonderful, phenomenal human being, Satnam Alag. So I was deep in software, and
yeah.
therefore it was not an alien category to me. And I love the fact that you can invest in it. And that, and so what was called big data analytics or machine learning then has evolved to AI today.
Yeah.
But it's the same, back now you're using PyTorch. Back then it was, Hadoop or whatever the terminology and the frameworks were at the time. But having that experience, expertise, and conviction meant that we were doing AI earlier than anyone else. And we still are. Right now, when I look at our early portfolio from Fund 3, and our current fund is much larger than our prior funds, we're writing much larger checks. Almost every company is an AI native company.
Yeah.
Even if they're doing, treatments for, let's say we have a longevity company,
Yeah.
Integrated Bio, which is phenomenal. They're doing animal experiments, mice experiments with hundreds of mice at a time. And just the level of data creation
Wow.
is extraordinary and it's designed to feed AI
Yeah.
because
Yeah.
the missing link for bio today is the data more than the
Yes.
models. And
Yeah.
everyone knows this in the industry.
Totally.
You have trillions of tokens in video and text and search that allow you to have these phenomenal results when you do you ask ChatGPT to write you an essay or, draft my email or
Yeah.
create a video. You can't do that in biology. You have these virtual cell models that are still incomparably deficient when you compare them to their analogs in the world of kind of digital.
Mm.
And so we're trying to solve for that by investing in companies that are able to create the data and the data moat upon which models can be built that have higher fidelity outcomes that could really help understand biology, which we still don't. I mean, anyone who says they do is aspirational,
Yeah.
which is great. We are aspirational as well, but the money will be made in the data for the next, I think, 10 years. But I do think in 10 to 20 years, we're going to have virtual cell models that'll be so revolutionary that they'll be really comparable to what we're seeing today in video
Wow.
and text. Yeah.
Wow. I mean, that's exciting. Like let's dig in a bit on AI. You're saying obviously you've been around it to some degree, but we all know that in November it felt like the world just tilted completely differently. Yes, for sure in the sort of like text video, kind of written word space. But for you too, like what across your investments now, like today, fresh day, genomics related diagnostics or therapeutics or the software digital side of it, I know they're all very different, but like walk me through what has changed or not when it comes to the fact that AI has sort of reached this very interesting sort of inflection point, at least for those of us who are living here in the Valley. I know the world has not yet necessarily caught up. And what is, if it's changing anything about how you're investing?
Well, we follow closely what founders are doing.
Yeah.
We are not a fund that has yet incubated a company where
Yeah.
we say, this is our thesis, let's go find the founders for it. Those funds are great. We have not yet done that because we have our hands full just supporting brilliant founders who come to us with ideas. And what we've seen is exactly what you've indicated. 2025, I think will be seen as the seminal year for AI. Obviously, we're now, almost halfway through 2026, but I think 2025 was a year where we started to see what could be considered magic through AI. And and then we started to see that in biology as well, where the founders that would come to us from the top schools, Harvard, MIT, Caltech, Berkeley, Stanford, schools that we disproportionately see founders from and fund, not because we're biased, but because that's where a lot of the funding is and a lot of them come to us. Now we're increasingly making an affirmative effort to make sure we're also in Texas, to make sure we're in Chicago and a lot of other geographies, Europe. But the founders are the ones showing us that the best founders are AI native, and they're not considering AI like this adjunct to what they're doing on the chemistry wet lab side, but rather the core component of it. And again, it's not like we invented the thesis and said, go and do this. They were doing it. They came to us. And now that I'm looking at the portfolio, we started labeling companies based on which ones are really AI native versus not. And I would say out of our current portfolio of diagnostics, health tech, and therapeutics companies, 80% are AI native, where it's like a core component of what they do. They have proprietary models, proprietary data, and they're doubling down on the use of AI to further their edge. So at this point, I think it's table stakes, to be honest.
Amazing.
And what I tell founders, even those that are going public, is you basically have a decision to make. Do you want to brand yourself as an AI native company?
Right.
Or do you want to be disrupted by someone else who does?
Right.
That's it. I mean, those are your two options. There's not a third option. And I also say, it was funny because you and I remember back in the day when the terminology that was used in 1999 was, this is a .com.
Totally.
Yet another .com. Like it's a bad thing. How many companies right now don't have a .com? And it's their URL. And that's kind of like, of course, everyone has a website. And many are online businesses or mobile businesses. And the same is true here. Someone might consider it gimmicky to say it's, civilization.ai, or if civilization were a company producing a non-venture product. And I think it's like everyone should be branding themselves with .ai as much as they could, because it's relevant to what they do. One of the funny things that's happened is some people have been raising these AI funds that of course, the hype is there. So, the institutional LPs are looking for the word AI.
Yeah.
So the fund manager will say, we are the AI fund for biology or life sciences. Great. And then what we see is that they look at some of our companies that basically are not AI native companies, but are doing extremely well, are curing disease. And they're like, we should really invest in this company. Do you have an AI strategy? Can you just make an AI slide for us so we could just kind of justify you being an AI company? And I've seen that a couple of times, and it's kind of hilarious, but because I'm like, you guys are an AI fund. There's so many AI companies. Why are you forcing a founder doing some, DNA, RNA editing, whatever it is, to just create an AI slide so you can pretend it's AI? I was like, come on. But you're seeing a lot of that as well for people that are realizing that the world is more complicated than only AI,
100%.
and they want to make money. And sometimes the money is in the chemistry, but they're saying just add the word AI. And so you realize that a lot of what we do, a lot of venture capital marketing itself is high.
Yeah, 100%. I remember this quote from Beezer at Sapphire, who said, the job of a VC is often to ride a hype wave and then get out just in time. I was like, this is true.
I think it's important.
And that's really hard. And timing is important, but also knowing the wave that you're in and really reading the tea leaves and moving with it is important, but you still need first principles, right? No matter what.
And you should be contrarian. And I think that the only way you make money is by being on that, on one or the other side of the bell for hopefully on the profitable side of the bell curve. Where you're not right in the fat middle, because the fat middle is the average returns.
Yeah.
And the way that manifests itself in venture is, if your thesis is the same as everyone else's,
totally,
it means that every deal you're doing is being chased by all the other VCs, and the price will go up. So you see a lot of companies, where the first financing round is at a 30, 40 post-money valuation, which, knowing how the exits work in our space, it means you're just not going to make any money at it. You're certainly not going to make the 20 to 100x returns, or even greater returns that you need to see from your winners to return funds.
For sure.
So if you're coming into these FOMO rounds where they're oversubscribed by a bunch of similar looking VCs with, following each other, you're not going to make money.
No.
You only make money by being contrarian. To your point, one of my friends was telling me this morning, well, you've established yourself clearly as the number one diagnostics venture firm in the world. And I said, well, I hope not, because that's not all we do.
Yeah.
It would be a pity if someone thought, because Civilization had, $7 billion of exits last year with $1 billion to one and the sale of Foresight and Natera, that somehow we're a diagnostics firm. We are not a diagnostics only firm. we've been very lucky and fortunate to have backed amazing founders
Yeah.
in diagnostics that have really moved the needle and have been able to build great businesses.
Yeah.
We've been lucky to have that. But we've been equally lucky so far anyway with amazing therapeutics founders. We have companies like Katina doing antibody drug conjugates
Wow.
that have preclinical data that we've never seen before. And that's one of the hottest areas right now in therapeutics. Yeah, you're seeing really billion-dollar exits like Cubulus that was just sold every week in biotech, which concerns me, by the way, because I worry about what's going to happen 2 years from now. But we have lots of cell therapy companies that, while risky,
Yeah.
could be total game changers for the industry where they succeed. So we do a lot outside of diagnostics, and we've been fortunate to have success in those other categories.
Yeah.
And we hope to have more, but fingers crossed, because a lot of this also is just, to your point, luck and serendipity.
Totally.
But I told them, please don't spread the word that we're like the most successful diagnostics fund, because that's not all we do. We don't want to. We would like to be known as a successful fund.
Exactly.
It doesn't have to be the most successful, although our metrics speak for themselves. But we would like to be known as a fund that's making a difference for founders.
100%.
That's helping patients.
Yeah.
That's helping the ecosystem thrive.
Yeah.
This is why we have our fellowship program, where we go into PhD programs and train PhDs in business and finance and venture capital and company creation.
Love it.
Because you don't learn that as a PhD.
Yeah.
That spends her time pipetting and working on, in vitro and in vivo experiment. You don't learn what's a term sheet.
Yeah.
How do you build a company? How do you hire? How do you exit? And we teach that to our fellowship program that we've started, and it's one of the most rewarding and fun things that we do. So we see our role far beyond making returns.
Yeah.
We do need to make extraordinary returns, and we've been fortunate to do so to stay in the business.
Exactly.
And I'm, I think I'm a competitive person. I like to be the best, but at the end of the day, we're all going to be at some point. We're on this earth, then we're not. And so all you can do is hope that we leave a mark that transcends our own kind of personal little needs, that we do something for the greater good. And that's certainly one of my aspirations. And it's actually why I call the fund Civilization Ventures. The name is meant to connote this idea that we're in this together. Doesn't matter if you're in Iran or Pakistan or China or the United States, we're all the same species.
Yeah.
Your language, your religion is kind of the operating system. The hardware's all the same.
Yeah.
And we're all going to the same place, which is hopefully a better future for all of us, hopefully longer life, longevity. And I really believe that technology is the one area where there should be no debate.
Yeah.
We should all be on the same page that this is good for all of us. And let's all invest together. Let's all create together, regardless of country or ethnicity or religion or language. Let's build together to further our common interests. And that's what civilization means to me.
I love it.
That this is our common technology foundation.
It's a very clear why, and a very deep why, and a very inspirational why that, I'm sure this is also part of why you win the early trust with founders at the earliest stages that you do. So let's talk quickly about that in the few minutes we have, which is, what is the stage that you're entering at? What do you call it now? Because, there's obviously changes in the size of the round and the valuations. Whether or not we talk about AI or the movement forward in therapeutics, you tell me, what does it look like for you to invest today? What's the check size? What's the, on average valuation? But also, what are you expecting at this stage now? We just talked about how much AI is changing, how founders can do what they can do. So is there a higher bar, or is it kind of look the same?
Very important question. We invest from pre-seed to exit. And with our new fund, which is substantially larger than our prior funds, we can do it all from one vehicle.
That's amazing.
Before we were, going to our growth vehicle and doing sometimes sidecars.
Your AUM for this fund
is 150.
Nice.
And what that means is that our first check can be anywhere from 100K if it's a discovery check to 4 or 5 million.
Yeah.
And we've done 6 million first checks. We will follow in to track success. And our largest concentrated investments in companies that have now fortunately exited have been on the order of 20 to 25 million.
Amazing.
So, and that's in the past.
Yeah.
So I hope and believe that in the future, we'll be able to take that to closer to 30, 40, 50 million per investment, if we're lucky enough to be in companies that truly scale. And in the past, we have been. So Billion to One obviously raised, $500 million. Olada raised $500 million. Foresight Diagnostics, which we sold to Natera's, raised almost $100 million. And in each of those, we were between 20 and 25 million.
Wow.
We had huge outsized ownership. And so and by the way, that was done when the AUM was very small. So
Yeah.
that took a lot of hustle, which is one of the things that I love, doing is seeing a challenge and trying to rise to the
I
occasion.
love it.
Now we hope to have more of a dedicated fund that can do that just very easily. But the portfolio construction is really predicated on success. So what we don't want to do is to put huge checks into things that have very high risk of failure.
Yeah.
And so if we think something needs to be de-risked, we will fund to that de-risking inflection point and then put further capital, which is, I think, fairly standard in venture
Totally.
capital.
Yeah, I love it. And tell me, maybe let's wrap on this last question, like tied to this whole change in, how AI is just, it's a substrate, it's not like a thing. It's everywhere, right?
Yep.
How does it change what a founding team looks like in your industry? Obviously, it's changing, the software founders and to some degree the hardware founder companies as well that, we tend to invest in. But, we do have a few biotech plays, as you know. But tell me, what does it look like when you meet a founder day zero and you're coming in at that pre-seed? Is the team composition different given AI in any way? Is it leaner? Is it not? Is there a different role that is showing up that, matters on the founding team?
Well, it's an excellent question, specifically in AI, because you have a lot of people from tech who are, AI experts working at places like YouTube who are now entering biotech. And I think
Love that.
we embrace that. We embrace quote unquote outsiders coming in and becoming the leaders and the new insiders. I believe in that.
Mm.
I think a key component of success for those companies is to make sure they quickly bring on board talent from the industry that can make sure they avoid basic mistakes. So it's wonderful to have an outsider's perspective and to come in with a contrarian or have an orthogonal approach, but you have to make sure you understand the game well enough that you don't make careless errors.
Yeah.
So that's the key, is to combine that alpha, that kind of novel thinking and innovation with traditional blocking and tackling so you don't miss out.
Yeah.
Now having a bunch of conservative people from the industry who just know how to do drug development, absent the novel insight, is not something we're going to find. But also having, two PhDs that have only done coding come and say, the diagnostics is easy. It's just a black box and just push a button and the AI solves it. We're not going to fund that because we know better. So what we like to see are people that are deep in the chemistry and the biology, also working with people that are deep in the AI discipline and field and frameworks, but then they work together and then you have founders that are complementary.
Yeah. Thank you. That's so great. Let's wrap on the last question, which is, what are some spaces you're hoping to fund in the next 12 months?
We're doing a lot in longevity, and longevity is a buzzword, so it's dangerous, but also there's a real promise there. And again, a lot of people fake it till they make it. They pretend it's a longevity company, or they randomize things like stuff that's obvious. But what we're trying to do is figure out novel pathways and approaches to longevity that could actually go from average age of 85 to 150. I mean, we're really trying to shoot for the moon when it comes to longevity. We're not trying to be incremental. I don't think you can be. We're doing a lot already that is really longevity. In every cancer diagnostics, every cancer therapy, every autoimmune therapy that we're backing, every rare disease therapy, including the one that was just approved by Rocket. These are obviously longevity plays because anytime you cure disease, you're living longer.
It's true.
But what I mean when I use the word longevity really is the average life expectancy in the US doubling. That's what I consider the bar.
Yeah.
And that's what we're targeting.
I love that because I had my kiddo late and I would love to be here much longer to see him get married. So,
Inshallah, I hope you are. I hope you are.
me too. Oh my gosh,
sincere.
Shahram, I could talk to you for hours. Again, as I said in the opening, like the way you see the world, the way you think, I appreciate it, not just from an intellectual standpoint, but it's the future that I really want us to live in. Precision, preventative, really putting technology at the forefront. And, while of course biology, biotechnology all has to have some level of conservatism that you've shared, we also need to push it forward. And so like your energy in this space, thank you for doing what you do, because we're all going to be healthier and hopefully live longer for it.
Thank you for having me. Such
You're
an
the
honor.
best. Thank you so
I
much.
enjoyed it. You're the best. Great to see you. Thank you.
All right. Welcome back. That was another great episode. Hope you enjoyed it as much as I did. So typically, I listen to the episode as soon as we record it, take some time to reflect, do some thinking, do some writing, and share back my takeaways. Many of you have said how much you enjoy the takeaways, which I appreciate because this is why I'm doing this. I'm doing this to take the time to think and reflect and have my own thoughts about what other people are saying. So it's the real reason for doing all this is to have some takeaways. However, I'm going to change the format of how I share my takeaways. And there's two reasons for that. One is I want to hear from you. I love recording my thoughts, but it's also great to hear what you all think, the listeners. So, whether you're an angel investor, a venture capitalist, or a founder, I want to hear your thoughts too. If you agree or disagree, or have new thoughts, or have questions, I'd love to hear what those questions might be. So that's one reason is I want to be in conversation. I want to be in community with all of you listeners. The second reason is things are changing in a good way for me, which is going to make it harder for me to take the time out to come back on to record. It's going to be much easier for me to spend time writing and thinking and putting that out via our newsletter. And I'll share more about why things are going to get busy in the next week or two, but it's all good stuff. And I'm super excited to let you all know. So, with that, if you have not joined the newsletter, and I know some of you already have, thank you for that, please join. And once you do join, you'll only get messages after every episode, nothing else. But I invite you to share your thoughts with me or reflections, or even just like let me know if that was a good or a bad episode. I just want to hear from you all. I want to be in better connection with my community. So, with that, go to firstfunderspod.com and drop your name in the newsletter. I might have to manually add you because I know some of you listeners out there already, but please do that. And would love to hear what you think. Thank you again. Thank you for listening. Thank you for being a part of this community. And we'll see ya next time. Ciao.